My reading notes for Secrets of Sand Hill Road, Venture Capital and How to Get It, by Scott Cooper and Eric Ries. Whether you're trying to get a new company off the ground or scale an existing business to the next level, you need to understand how venture capitalists think. In Secrets of Sand Hill Road, Cooper explains exactly how VCs decide where and how much to invest, and how entrepreneurs can get the best possible deal and make the most of their relationships with VCs. Start as a C Corp to keep money in the company. Can start as pass-through, then convert. Makes it easier to distribute ownership. Allows different kinds of shares, different rights. Founder stock vesting equal to want to give long-term incentives. Full vesting is usually achieved after 4 years from date of option grant. Can only sell what is vested. Founder full vesting is usually based on predicted time to liquidity event you want to set up, so that the VCs cannot remove the founders. Many companies have hardwired board seats, meaning they retain their board seat if fired from job. Don't want them ruling from the grave, though. Blanket transfer restriction means shareholders cannot sell without company permission. Right of first refusal is more common, though. If founder leaves or does not go over to acquiring company, you can accelerate the vesting. However, it leaves less equity to divvy up to future employees or VCs. S single trigger equal to stock accelerated at any MA event. Double trigger equal to accelerated at acquisition, and the founder not being retained. More common. You want to have a clean computer outside of your day job to work on side projects. Don't download documents related to project. Employee option pools equal to generally is about 15% of shares. Gives them the option to buy stock at a future date and price. Incentive stock option ISO equal to most favorable. Employee does not have to pay taxes at the time of exercise on difference between FMV strike price. Referred until sell the underlying stock. NQO equal to non-qualified options, less favorable. Have to pay taxes at the time they get options. Can only issue $100,000 worth of ISO per employee per year. All ISO must be exercised within 90 days of leaving the company. This means they have to have the cash to pay the strike price to get the stock. Can have option to convert ISO to NQO. 1 year cliff vest equal to if leave less than per year from start of plan, get nothing. Then typically vests at 1/3 per month. Want to have timeline match liquidity event. Average time from founding is now 10.5 years. In a competitive job market, it's hard to get good people with longer vesting cycles. Sometimes, for really good employees, can refresh the vesting after year 1 to 2 to offer new, more options. Gives longer employment incentives. Tesla is known to provide smaller packages up front, then give more later if you prove valuable. The right time is when you can. Raising money. Everything starts and ends with market size. Can you create a profitable, high-growth, several hundred millions business over the next 7 to 10 years? Smaller companies need angel or seed investors, not really VCs, or debt financing from banks. How much do you need? Enough to get you to the next round of funding. When can you show the next investor or current ones that you have made significant progress and described the business? Generally, every 12 to 24 months. Common milestones equal to Series B will want to see that the initial version of the product is built, plus some indication that some companies will want to pay to be part of 3-5 meters in business or coming soon. If you raise too much money too early, you will have to give up a higher percentage of the company. Plus, evaluation in a previous round has nothing to do with future round valuations, though you also don't want to raise too little money at too aggressive of a valuation, because then the next round has to increase the valuation, and progress may not be sufficient. Could scare future investors from entertaining if a VC invests $5 million for 20% of equity, existing shareholders are diluted by 20%. So if you owned 10%, you now own 8% or 20% less. If sell another 10% on higher valuation, no own 7.2%. This also happens to ESOP, so they might think you are a liar. The pitch equal to VCs often find deals from angel and seed investors. Getting in front of investors is kind of a test to see if you will be able to get in front of customers. Pitch essential number 2 equal to market sizing. Biggest thing they have to understand. Can the business really be big enough to drive an outsized return to the fund? Pitch essential 2 equal to team. Answer why you, especially you as the CEO. What is your unique set of skills? They love infinite learners, aka founder market fit. Does your team have anyone who can get extra eyeballs? Why will people quit their jobs to come work for you? Why will other companies want to help? You. Tell a compelling story. Pitch essential 3 equal to product plan. Don't expect you to be clairvoyant. Want to see your decision maze. Pitch essential number 4 equal to go to market. Generally, the least developed. Might be at a high level. Are you doing brand marketing? Other forms of acquisition. Who are you selling to? Need to have theories grounded in reasonable assumptions. Have strong opinions, weakly held. If a VC offers a suggestion, don't take it wholesale. Might show that you are weak. Pitch essential number 5 equal to planning for the next round. Can you get to the next milestone? Will the next milestone provide a significantly higher valuation? You want the new valuation to be at least double the previous round. My reading notes for Secrets of Sand Hill Road, Venture Capital and How to Get It, by Scott Cooper and Eric Ries. Whether you're trying to get a new company off the ground or scale an existing business to the next level, you need to understand how venture capitalists think. In Secrets of Sand Hill Road, Cooper explains exactly how VCs decide where and how much to invest, and how entrepreneurs can get the best possible deal and make the most of their relationships with VCs. Term sheets equal to VCs do this all the time. Bound to get a couple shots on goal about economics and governance. Security. Preferred shares equal to higher priority shoes than the common stock that the founders and employees have. Arranged proceeds equal to how much money is invested for X of the company. Later. Would need to convert any debt to equity as part of this, as debt is usually senior to equity. Some startup investors get convertible debit to start. Debit that can be converted to equity. Based on occurrence of an event, like Series A, can be copped or uncombed. Meaning value set when get debt, or as series evaluation. Some say converts at an X discount to the Series Y valuation. Convertible debt paperwork is generally simpler, so lower legal fees. Post-money, the valuation of the company after the VC has invested. A $40 million company gets $10 million investment, it's $40 million pre-money. VC invests $10 million for 20% post-money because we're at $5 million post. Any convertible debt has to be in this valuation. Have to include employee option pool. Discounted cash flow analysis equal to the value of the company is the present value of its future cash flows. Required future income estimations. Discount rate equal to opportunity cost of other investments. Typically eat cash in early years and generate cash in later years. Gets tricky because there will likely be other capital raises, but can't account for the dilution. Some VCs will reserve for later rounds. Depending on fund's life cycle, what do I need to believe analysis is equal to working backwards from the requested and required rate of return timeline to see if it's feasible? Dividends, if paid, go to preferred shareholders, VC first before common. Means can't pillage. Liquidation preferences equal to who gets paid first in a liquidation event. 1 times means VC gets just their investment back. 1.5 times means 150%. Generally, 1 times in early stage. Sometimes 1 times in later stages there is likely less growth later stage. On sale, the VC has choice to take liquidation buyout or convert to common shares ownership percentage. Ability to do both is rare. There is also an order amongst VC seniority or pari-passu call treated same. Redemption is very unusual in VC. Would allow VC to give stock back and get money back whenever it wants. Conversion, the conversion of referred shares, common shares. VC might want if IPO coming, or can have dual-class voting structures where some common shares don't have same voting rights. VC will generally allow if the IPO is of sufficient size. Later stage can sometimes be return-based. On liquidation, employees get $0 unit. The fall liquidation preferences of VC are met. Can disincentivize the employees. The term sheet will dictate who gets to vote on whether the preferred convert to common or give up liquidation. Could say all preferred shares vote the same, or could group by round. Anti-dilution provisions equal to secures the VC in the event of a down round, i.e., 1 round valuation is less than 1% before, means you have to issue more shares for the same amount of capital. Creates a blended price to get more shares. Full ratchet, they get more shares based on new price to maintain. Dilutes founder and employees. Governance. Board of directors equal to hire fire the CEO and key personnel. Rarely get board seat without contributing 50% of a round. Generally, founder has a seat. CEO too. If don't put I on a provision, you can have someone fired or left still having control. Generally have an independent representative without ownership. Common controlled board equal to more director representing the interest of the common shareholders. Uber set up with 9 board seats, only filled 7. Travis effectively controlled 3, him, co-founder, another appointee. Then he could have quickly filled other 4. So they had to convince him to step down. Most companies incorporated in Delaware because they have the best, most thought-out laws, can put protective provisions as an overlay to make stricter, generally to give VCs more say. And don't want later-stage investors contributing less money to have outsized control. Can sometimes list a series of topics that a new investor can vote on. Or create a higher vote threshold for certain decisions. Term sheet states the things preferred can vote on. Examples: authorization of new classes of stock, corp action, acquisitions or sales of intellectual property, liquidation or recapitalization, increases in option plan. Pro rata investment provisions equal to typically give major investors in early rounds the opportunity to buy into later round maintain ownership. Stock restrictions equal to generally apply to major shareholders greater than 50% of stock only. ROFR equal to right of fire refusal. Get a bid from outside party, company has right to match buy, can waive. Co-sale agreement equal to, if I sell my shares, all the other investors have the right to sell their to the same buyers at same price. If the buyer only wants to buy a fixed amount, their sales come out of yours. Drag along if a majority of shareholders agree to something, the others have to go too. They'll generally need approval of BOD. And preferred in common as a group prevents tyranny of the minority. EO insurance equal to insurance to indemnify BOD SR managers. Capitalization table, carpetable, is handy way to log ownership over time. Always a balancing act, dilution versus money now. A 162 always says, just get enough to get you to the next round and maintain momentum. In public companies, board members are typically elected by common shareholders. Private is negotiated as parts of funding rounds. VCs or dual fiduciaries have a duty to the common shareholder as well as to her LPs that invested in fund. Board hires and fires the CEO. Issues stock options to employees, approves acquisitions, divestitures. Most have regular board meetings and make sure living up to duties of the board to maintain limited liability. Board members should not be too involved in the day-to-day of the business. My reading notes for Secrets of Sand Hill Road, Venture Capital and How to Get It by Scott Cooper and Eric Ries. Whether you're trying to get a new company off the ground or scale an existing business to the next level, you need to understand how venture capitalists think. In Secrets of Sand Hill Road, Cooper explains exactly how VCs decide where and how much to invest, and how entrepreneurs can get the best possible deal and make the most of their relationships with VCs. It's important to set your expectations of board members up front. How do you want your meeting ran? CEO needs to know if board members are reaching out to employees. Board member maintain legal liability safety by performing duty of care to the common shareholders. Must stay reasonably informed of what is going on. Must not self-deal or seek to enrich themselves. VCs must balance loyalty to LPs in the company. Chinese wall equal to formal process where one GPE a VC firm will not share information from one board with the GPE on other board. Must act in the long-term common shared interest of the common shareholders. Preferred shareholder rights are contractual nature. If suing board, have to show that the process was bad, not the judgment. For example, dual fiduciary getting benefit does not automatically compromise them, can require them to read this book and enter in minutes. Court ask, was it a fair process and a fair price? When the company is doing poorly financially, it's necessary to recapitalize. Often, the first attempt is obtaining bridge financing. Generally as a cash infusion from existing investors as a convertible note under terms of the last round of financing. Restarts the journey toward success. Sometimes have to retroactively lower liquidation preferences to attract new investors, more money. Can reverse split by converting their preferred shares to common. Sometimes as much as 10-1 provide. Lower valuation to restate to current value of company. Awarding new money too close to a deal looks fishy. Good idea to have a banker show deal to a bunch of no's. MIP equal to management incentive plan. Plan to pay monument to pray for a sale. Needs to align W common shareholder interests. Warn Act equal to have to give advance warning of shutdown. Generally 60 days. Faltering company provision equal to exception if trying to get financing and notice of layoffs can. Jeopardize. Positive exit equal to companies get bought not sold. Buyers will generally want seller to indemnity them against certain things. Revlon standard equal to while the board has no obligation to sell the company. But if it does go down that path, it must seek to maximize the value of the common stock. Should 1. Reach out to multiple potential acquirers with the help of bankers when possible. 2. Consider other potential paths forward. For example, financing authority to maintain. Autonomy. 3. Consider incorporating a go-shop provision into an offer they receive from an acquirer to permit for competing bids. 4. Document. A well-vetted process to show the board considered these. Overview of the IPO equal to reasons to go public. Raise capital equal to becoming less important. Can get hundreds of millions or billions privately. Branding equal to used to be a bigger event. Liquidity equal to ability of employees to convert their ownership shares to cash. Hard to sell shares of private company. Customer credibility MA currency equal to all product has a life cycle. Might need to build or acquire new technologies. Stock market is a daily price of worth. Process, beauty contest, or bake-off. 1. Pick a bank to underwrite. Research analysts who will publish info on the company. Interact with institutional buyers frequently. We'll do thesis on company. Consider the strength of their trading desk, generally co-underwriters. 2. Roadshow equal to 7 to 10 days of meetings with investors. 3. Confidential filings with the SEC. SEC want to minimize hype. 4. Prospectus becomes publicity. Available. 5. Building the book equal to talking to institutional investors to gauge, invest, and price. 6. Final SEC prospectus approval. Pricing the IPO equal to very difficult. Generally leaves one of the partners unhappy. Raise the most money with the least dilution. Very bad if goes down first day. Negative sentimental can ease self-fulfilling. 8. Green shoe process equal to investment bank may buy, sell to stabilize price for 30 days. VC's founders typically can't sell for MOS longer on BOD. Secondary offering of shares equal to orchestrate a secondary offering. Generally to existing institutional shareholders. Shares owned by someone else, not newly issued. Proceeds are to the holders of the shares, not the company. Can help get shares into friendly hands. As CEO, you have a new set of bosses, governance rules, and scorecard. Cap table typically 60% for founders, 10% for employees, 5% advisors, 1%, 5%, 25% investors. On pre-money valuation, equal to typically want to give up 10 to 15% if you're great. Normal 20 to 25%, worst case 30 to 35%. How to build a software company with no money. By Dan Martell on YouTube. Equity splits have to motivate the futures of the participants. People who are full-time and all in, not contractors.